you know what a good profit factor is for your trading? Do you know how to calculate it? Do you know what it means? Well, that's what we're going to talk about. But first, what's an equity curve? What your equity curve does, it's going to show you the performance of your strategy over time. And you can use it to evaluate the effectiveness of your trading system. And you can actually use it to compare different strategies. So it plots the cumulative profits and losses of your system as it trades through different market conditions, different times. And a good profit factor is going to have a certain look when you see the equity curve of the tested strategy. So the shape of your equity curve, it's going to vary. It's going to depend on how successful your strategy is in making money. A flat one means no gains or losses, it's useless. A curved line, that's going to indicate profits that either increase or decrease. So with that equity curve, we can visually gauge how efficient our strategy is. It's going to allow you to determine whether modifications should be made. And by comparing different strategies side by side, you can see which one's going to be more profitable and decide which one you're going to use. Now, traders are going to look at individual trade results when analyzing their curve to identify any patterns that can help in the future, help you make better decisions about what type of trade. So, for example, if you notice that your winning trades tend to occur after a certain news event, well, then this could indicate that you should focus on taking those types of trades more often than others. You can also use that equity curve as part of a risk management practice, such as setting stop loss levels based on historical drawdowns, which is the amount of money lost during any given period. So this is going to help ensure that even if there are some losing streaks, and there will be, your account's not going to suffer a whole lot of damage due to excessive risk taking, since you'll know when it's time to pull out before things get bad. Now, profit factor, we can define that as a division of the overall gross profits divided by the gross loss over a defined period. A profit factor is a metric that we use to measure the profitability of a trading system. A higher profit factor implies that profits are greater than losses, while a lower one suggests that losses are more common. So a profit factor of 2. For every dollar lost in trades taken by the system, 2 are made. So your profit factor would be, for an example, $10,000 of wins, $5,000 of losses. So this is going to indicate that this system is pretty decent. Profit factor of 1, neither profitable nor unprofitable. Break even. A value less than 1, well, that's just a losing strategy, and avoid that one. So the calculation of the profit factor, it's useful when you compare different systems, different strategies, because it's going to give you an indication of which one has a higher probability of being profitable over time. So for instance, one strategy may have achieved greater returns, but at higher levels of drawdown compared to another one, which could lead to lower overall profitability or longer losing streaks. So when you look at the respective profit factors, you can decide which strategy is more suitable for your goals and whether or not you can stand those large drawdowns. Now, a higher profit factor doesn't always ensure better performance. So again, as you all should know, past performance should not be used as the sole determining factor when making decisions. Rather, it should serve as a guide. How do we calculate it? Simple. Gross profits generated, divide by the losses, including commissions from all trades. So a trader has used a particular strategy for 50 trades, has the following results. Total profits 10 grand, total losses 5,000. Calculate the profit factor, divide total profits by total loss is 2. Now again, a higher profit factor doesn't necessarily mean more money is going to be earned, but it indicates the degree that winning trades are greater than the losing trades. You still may experience periods of drawdown even with a high profit factor because of the market conditions or other factors. Now, when you look at historical performance data, it's really easy to spot patterns, and that's going to suggest whether there is an edge present with the system that you're using. So these patterns can be seen when profitable streaks outnumber losing ones over time. This is resulting in a positive expectancy across multiple trade sizes and markets. The same applies for automated strategies, where the backtesting results show consistent returns despite changing market conditions over long periods of time. So this indicates that the strategy is robust. So what's a good profit factor? A lot of traders look for anything over 1.2. Some traders prefer 1 over 2 or 3. So just because the system has a high profit factor, it doesn't mean it's going to continue to perform well. Market conditions change all the time, so it's always best to test any new strategy before committing real money into it. At the same time, even if you found success with one strategy, don't get complacent. You have to constantly monitor its performance and adjust as you need. And there are other factors worth taking into account, like drawdown percentage. That's the maximum amount lost at any point. And the Sharpe ratio. That measures how much return was earned per unit of risk. Weighing all these metrics in combination to create a strategy performance report, it's going to help you find the right trading plan based on your objectives and your risk tolerance. And profit factor is important. It's a simple and effective way to measure the effectiveness of a strategy, right? You get to compare different trading strategies, determine which ones are more likely to be profitable in the long run. It's going to help you make better decisions about which trading strategy to use, and hopefully over time lead to higher returns and a successful trading career. Now, some trading systems may have a very high profit factor, but they don't perform well due to their lack of consistency or predictability over time. And this happens during system design when a trader curve fits the data to ensure a result from the tested system. So you got to understand how reliable any particular system is and how it's been designed and tested before you commit real money to it. Understanding this concept of profit factor, it's pretty vital to success. Knowing what an equity curve is, what it should look like, what a good profit factor is, how to calculate it, and why it's important is going to help you make better decisions when you're trading. Opting for higher profit factors, something you should really want to do. And with this knowledge, you can use your own data, evaluate your own strategies, and maximize your profits with just little tweaks to your trading plan. And if you're tired of using overused indicators, and let's be honest, there's so many out there, it's something a little bit different. It's a free guide. It's called The Ultimate Guide to Price Pattern Trading. It's one of our most popular giveaways we've ever had. The link is to the left or in the description below. Thanks for watching.